What is going on, investors? Hopefully you guys are having a great day out there. Time to talk about AT&T Incorporated, ticker symbol T. The company just reported their Q2 earnings before the bell today, and we will get into them. We'll take a look at the operating revenue. We'll take a look at the operating income, the net income, the cash flows, all things related to AT&T. We'll also take a look at the stock chart with AT&T. Look, this thing, after announcing the deal, which we'll talk about here in a second, with Warner Brothers and Discovery Inc., this stock has just slid. It was up at 33 bucks and now it's down at about 28 bucks. And quite frankly, this stock, unlike almost all stocks in the stock market, just simply has not recovered since the March drops we saw of last year, really across the board in the market. This stock has not recovered. So I'll talk about, is this a buy the dip opportunity? Can you come in here and scoop up shares of AT&T on the cheap, or is this thing simply dead money until the AT&T Discovery deal is consummated? So we'll talk about that here in a second. But over the last year, this stock is down 7%, year to date down 3%. But look, you're still getting $2.08 per share on a dividend. That's good for over nearly 7.5% yield. Tell you what, I own some AT&T shares. When those dividends come in, it's almost unbelievable because it is so much higher compared to almost anything else out there in the market. So there is some attractiveness, at least from that sense, in the shorter term. Now, what I have here is an article on Seeking Alpha that was published today by GS Analytics. I'll include a link to this gentleman's work in the description below, and you're more than welcome to come check this article out. Now, it has some opinion in this article, but what I wanted to do was break out. I thought he did a nice job of explaining the AT&T deal. So we're going to talk about that first, and then we'll get into the numbers as well. So what I wanted to do was talk very broadly about the AT&T, Warner Brothers, and Discovery deal. So what happens right now is AT&T currently owns Warner Brother Media, which is essentially TNT, Warner Brothers Studios, CNN, a lot of other media assets out there. And what happened is AT&T decided, I want to get rid of that. Okay, we want to become a pure play communication company similar to T-Mobile, similar to what Verizon is in the process of doing right now. And we're going to focus on that, and we're going to spin off this Warner Brother Media Group. We're actually going to essentially sell this business and combine it with Discovery, which is Food Network, Discovery Network, and some other TV assets as well. And so it's going to combine those assets and leave AT&T as simply an internet wireless phone communication company like it once was. And so you, the shareholder, are going to benefit from that, okay? Because technically you own Warner Media as well. And so there's going to be a new company formed. There'll be a new ticker, a new stock for Warner Brothers and Discovery. And if you own shares of AT&T, you essentially own $6.30 of that. Now, these numbers can change over time, and depending on when this deal finally is finalized, these numbers can change a little bit. But it is estimated at the current time, if you own AT&T shares, you're going to get about a $6.30 per share stake for Warner Brothers and Discovery. Now, how are you going to get that? AT&T described that you are going to get either cash, you're going to get shares of the new company, or you're going to get a combination of both. Like, for example, maybe you get $6 per share in the new company and you get another 30 cents per share in cash, in like a cash dividend. So let's think about that, okay? You're going to get over $6 per share in a new company. That is nearly 3 years worth of dividends, because currently you're getting about $2.08 per share on AT&T shares. Well, you're going to get about $6 per share just for the privilege of AT&T spinning off the Warner Brothers Media Group. Now, what is going to happen is when Warner Brothers is extracted from AT&T, the value of AT&T is going to go down. The enterprise value of this company is going to go down. So the share price of this company is going to drop as well. And many estimate it's going to be in that $21 per share price after you extract about $6.30 per share for the Warner Brother Media extraction. You're going to be left with about $21 per share for your AT&T shares. Now, it is estimated that the dividend will be cut in half to $1.04. But keep in mind, this is what I want you to keep in mind, okay? that the yield will still be 4.8% or around there in that 4.5% dividend range, which is comparable to a Verizon, which will be a similar business once both those companies shed off all the media assets they've tried to acquire over the last few years. So yes, your actual total payment per share for AT&T will go down. It'll go from $2.08 per share down to about $1 per share, but the share price will also have gone down because you will have been paid out for your Warner Brothers, the portion of Warner Brother Media that got spun out. So you will get several years worth of dividends in the form of a new company, whether it's shares or cash or a combination of both. Your dividend rate at AT&T will go down, but your yield will likely still be much higher than the market average. Will it be 7.5%? Probably not. It'll probably be in that 4 to 5% range, which is still not that bad. So just keep that in mind. I'll let you to decide if that's something that is attractive to you, okay? Obviously, as we've seen over the last few months with AT&T, many investors, probably many investment funds as well, which held AT&T, probably decided this was too much for me. I don't want to deal with this. We're just selling out of this thing. And that has caused this stock to go on a massive decline over the last few months since this deal was announced. Now, we'll put the deal on the back burner now that you understand what's going on. Again, I'll include a link to this article in the description below if you want to read through it in a little bit more detail. What we're going to go over right now is the Q2 results. We'll take a look at the operating revenues. I think it's still important if you hold AT&T shares, if you're interested in this company, it's still important to understand how these numbers are looking because you are going to be left with a very, very large portion of this company when things get finalized. Now, we got our operating revenues coming in here. I love this view over at AT&T. They basically give you like a 2-year view, almost, actually more than a 2-year view. So here's our most recent quarter here on the right-hand column, and you see our revenues came in at $44 billion. So it's up a little bit quarter over quarter. And then we take a look year over year, up quite nicely over compared to about a year ago. And compared to 2 years ago, basically flat, down just slightly. So all things being considered, the company actually is doing a pretty nice job in terms of getting these revenues or at least maintaining them at a certain level. Now, we've got equipment, broadcasting and programming operations. Obviously, this expense might happen to go away once they shed the Warner Media business. They've got other costs. They've got selling, general, administrative. They've got these asset impairments and abandonments. We'll see how that impacted the financials as well. And you've got depreciation and amortization. That is a non-cash charge. We'll talk about that when we get to cash flows. All things being considered, what I look for when I look at operating expenses is how do they compare to like a quarter over quarter and a year over year? All things being considered, these all look well within line. So we are ticking up revenues, at least on a quarter over quarter basis and a year over year basis. All things being considered, they've done a nice job keeping all these operating expenses in line. Now, where we have kind of an anomaly here, or at least to a certain degree, is we've got these asset impairments and abandonment. So we had to add on $4.5 billion. That makes our total operating expenses at $40.7 billion. That's a little bit over where we were in the previous period, primarily due because we didn't have that asset impairment in the previous quarter, and we did in this quarter. Now, there's been other quarters where they've taken these asset impairments, but if you strip those out, they're in this mid-30s in terms of operating expenses, and that's exactly where AT&T is right now. So they've done a nice job controlling costs. It's a very, very steady company, as you can imagine, and they've done a nice job keeping things relatively steady. The other thing that I want to focus on here is interest expense. I'll talk about that here in a second when we get to operating income. So operating income for the most recent quarter came in at $3.2 billion. As you can imagine, when you have these asset impairments, it really hurts the operating income because they had to recognize this. So when we get over to cash flows, we're going to be able to add this number back in. We'll take a look how, from a cash flow perspective, AT&T has compared to previous quarters as well. But all things being considered, everything looking relatively on par with what you'd expect over at AT&T. The last thing I want to talk about is interest expense, at least on this sheet. We'll move to cash flows here in a second. is interest expense. Lots of people talk about the debt that AT&T has. And look, it's a massive amount of debt. In fact, I think it's the most out of any corporate out there, most of any company in the world, outside of maybe like the United States government or something like that. But take a look at interest expense. It was sitting at a $2 billion, $2 billion, $2 billion, $2 billion, $2 billion, 1.9, 1.8, $1.7 billion. So while they have taken on a lot of debt, they've added more of it to the balance sheet. The cost of that debt goes down. And I think as an investor, you really should focus on that number. Okay, with interest rates where they're at, with refinancing and all the kind of financial engineering that these companies can do, the fact is the cost of that debt has gone down, and that is a good thing for AT&T. Now, moving down to cash flows, because I talked about how they had some of these charges. So they got depreciation and amortization. You can imagine a company like AT&T that buys lots of equipment and trucks and all those types of things. Well, they have to depreciate that stuff over a period of time. The other thing they had is that asset impairments and abandonments. This is not necessarily something related to operating the business as well, although when you've made as many mistakes as AT&T's management has in the past in acquiring assets that just didn't work out, when we're talking about DirecTV and even Warner Brothers Media, which doesn't look like that's working out from a financial perspective as well, at least in the shorter term. Well, you're going to have a lot of these asset impairments and abandonments, but guess what? On cash flows, you get to add them back in. So we pull down this net income number, which we see is sitting at about $1.9 billion. You notice it's much smaller in comparison to most other quarters, but we add back in some things, okay? We get to add back in this impairment loss, and we get down to net cash provided by operating activities, and we see it came in right at about $10.9 billion. And we see as we compare that to other quarters, it's essentially in line. So this was by all means, all things being considered, essentially an inline quarter for AT&T. And I think most people were expecting that, okay? Inline from a cash flow perspective, inline from a revenue perspective as well. Now, in terms of the other things that they've got going on, not a lot of investing activities here in the quarter from AT&T. They didn't do a lot of acquisitions. They didn't do a lot of investing into the business and those types of things. From a financing activities as well, you didn't see a whole lot as well. You didn't see issuance of short-term debt or long-term debt. They didn't really pay down a ton of debt. They did pay the dividends in the quarter, but all things being considered, not a lot going on over at AT&T. It was a sideways quarter as this company moves into this deal being consummated and finalized. I think you'd expect that with AT&T because management and shareholders are kind of in limbo with AT&T, right? We're kind of all just waiting for this deal to be finalized, for Warner Brothers Discovery to be spun out and be a separate stock, and you, the shareholder, decide if you get shares in that company, whether or not you keep them, whether or not you sell them. Maybe you get some cash dividends off that. What the dividend yield will eventually be on the new company of AT&T, because we talked about how they're going to shed off $6 to $7 per share from this company, at least at the current price and the current deal formatting. So that is going to knock AT&T down to about $20 to $21 per share. And if you get a $1 dividend, $1 and change dividend, well, you're making about 4% on your money at that time. Now, let's talk about the stock chart, because from a technical perspective, this thing has been in, I wouldn't say a tight range. We've bottomed out here at about 27, call it even $26 per share. If you want to move this bottom trend line all the way down to about the bottom, you're looking at about $26.50 as the bottom on the shares, and you're sitting really only about $1.30 above that at the current time. Certainly, if AT&T were to walk all the way down to $26.50 per share, that'd be something I wouldn't necessarily run out and buy a bunch of shares, but I'd probably add to my position. I probably have 30 or 40 shares of AT&T. I collect a nice dividend. I reinvest those dividends, all things being considered. It's not the worst performing stock that I have in my portfolio. And in my opinion, I have a portfolio that is tilted all the way towards growth. Amazon, Nvidia, Apple, Netflix, Microsoft, not Netflix, and a bunch of other high growth names. Okay. And so there's nothing wrong with having a portion of your portfolio, couple $1,000 in my case, that is just out there churning out cash flow and dividends. And in that case, AT&T, Verizon, Realty Income Group, SPG, and numerous other companies out there serve as my way to increase my dividend yield on my portfolio. And so certainly if you came down here to 26.50, might be kind of interested. I'm not really interested in the company as we sit here kind of in the middle of a range. What are you looking for with AT&T? From a technical perspective, you're looking to get above these highs because right now you are in a very well-defined down channel with this one, okay? This stock is channeling down. It really created this nice little gap here, and we are channeling down. And until further notice, this stock is stuck in this channel, but at some point we are going to form a bottom with this one. Okay, we did notice that this stock kind of channeled down here. It created some upward momentum. This looked like maybe that was a bottom, came all the way down here and then rallied hard. I wouldn't necessarily, if this stock bounces somewhere in this range, wouldn't necessarily look at that as a bottoming formation. What you got to do is get above, and I'll take out some of these lines just so it's a little easier to see, is I think you got to get above these highs right here for it to really be counted as, okay, this is a bottom right here at $27, $28 per share. You got to get above 29.5 on this one, in my opinion. You get above 29.5 on AT&T, which is again about $1, we'll call it about $1.60 away from where the stock is right now. I think you have a high probability of filling this gap, because what is going to happen is if AT&T is able to walk this stock price back up in here, well, this gap could potentially be filled, okay? And then we might fill this gap. But again, that's from a technical perspective, and ignoring everything else that's going on with AT&T, but you simply can't do that, okay? This deal, I think, is still a little complicated for the average investor to understand. I don't think a lot of investors are really understanding, look, you're going to get like 2 to 3 years worth of dividends in the form of a new company, and your remaining dividend yield on AT&T, it's going to be, quote, cut in half from a dollar perspective. Yes, you're going to go from $2 per share down to about $1 per share, but keep in mind, you're going to get 2 to 3 years worth of dividends in the form of another company, and the yield, which is the percentage of this dividend rate versus the stock price, the yield is not going to be cut in half. Well, if AT&T keeps going down, it might, but it's only going to be cut by a small factor. And then when you factor in that you're going to get 2 to 3 years worth of dividends from the new company, it's actually not that bad of a deal in terms of when we're looking at it from that perspective. So I'm not endorsing buying AT&T at this level. If we come down here to 26.5, we retest these lows that we've made over the last year. Yeah, you want to take a shot at it at that level. I don't mind that, okay? Because once this deal is consummated, then I think the average investor can start, and even like the average fund out there can start digesting both companies separately and start re-rating each company separately. But I think this company is dead money until then, and we're still probably 6 months away, maybe even longer, until that deal is finalized. Again, I'll have a link to this article in the description below. Hopefully you guys had a great day out there. Good luck with your investments.